Hey there, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial conclusions, and make your own financial decisions. This is Blockhead Traders for the week of April 20th, 2025. And in this week's episode, I'm joined by fellow Blockhead Trader Viper XL 007, and we are going to take a little bit of a dialogue around the latest market thrashings, up and down, sometimes multiple percents a day, in all of the wake that still is unfolding from the tariffs that we talked about in last week's episode. And throughout the trading week, it really hit me that perhaps some of the best advice comes from the 80s movie War Games, where sometimes the right answer and the only winning move is not to play the game. And we'll talk a little bit about how that might fit into your comfort with the market and where the market is reacting this week. But before we hop to that, I want to give a shout out to our Discord, link in the description below. You can hop in there, say hello to myself, Viper, some of the other Blockhead traders. Love to hear what you're trading. Love to hear what type of content you want to hear about. Also, you can find a link to thetagang.com/sprocket888, where I post each and every one of my equity trades, the good, the bad, and the ugly. You can also find /ViperXL007. Also, this is available in an audio-only format wherever you get your podcasts. So look us up, subscribe, and if you can't find us there, let us know and we will get it there. But let's hop to this week's episode. Viper, man, has it been a very volatile week in trading. Every day we were flying in one direction or another. Sometimes just within the day it was kind of lulling, and then monster candles kind of opened up. And you know, this has really caused me to deviate from my regular trading style. So, you know, I'm a big premium seller, and earnings is one of the binary events that I love to trade with options and sell them. And, you know, this week was the first week of earnings season, and I have not played a single earnings. I think the banks reported this week, and I had my screeners up over the weekend kind of looking at potential plays for the week, and it was full of hits from an elevated volatility and stuff like that. Now, granted, what the reason of the elevated volatility tends to, or what I attribute it to, was just general market volatility, because normally my IV percentile, you know, ranges anywhere from, 30%, 40%, 50%, and I'm really targeting anything over 50%, but there was usually a wide spectrum of that. But this, I think, like the top, 30, 40 hits, of almost every single one was at 100% IV, 100% IV, not spot volatility, but relative to historical. And to be honest, that just put me a little bit outside my comfort zone to have everything pegged that high. And the reason is because when I play earnings, I really look for that volatility contraction. And with so much uncertainty in the market, I really theorize that there might not be that volatility contraction, and I might be actually fighting against the time expiration, which is fine. I mean, that's part of the calculus that I go into. But if you don't get that volatility contraction and you actually get that volatility move in the underlying, it's not quite as easy to profit off of that premium selling. So I just stepped back from that normal strategy and said, yeah, not for me right now in this market. And I think that's where I'm saying here that, maybe it's okay if it exceeds your comfort or exceeds your strategy. Like sitting on the sideline waiting for what you like to trade is a legitimate thing. Viper, I don't know if you experienced anything like that, or what this past volatile week has really been for you.
Yeah, it's been, I don't want to say like quite the same. I mean, a lot of the same sentiments there. Not on the sidelines, but I'm thinking a lot about if I was on the sidelines.
Well,
and
I do want to. The reason I'm talking about the sidelines is I'm not actually on the sidelines. My regular strategy is on the sidelines. I've been making plays, but what I really want to kind of call out is just because Viper and I are talking about trading the volatile market, surfing the really tall waves, Don't take that as a, oh my gosh, I've got to be in there and doing it.
Yeah. Yeah, that's fair. And basically, so what I've been doing is, I mean, I've been trying to take advantage of the volatility in a very different way than you have, or some of the other traders in the Blockhead Traders Discord. Shout out to the Discord, where there's a lot of VIX action in there, which is, I think, perfect for this moment. Is trading on the volatility index on the VIX, because I mean that's just, it's gonna ripsaw up, it's gonna ripsaw down, and it's just gonna ping ping ping. But I am trying to take advantage of it. And kind of one of the things that I've noticed and we can get into a particular chart to back this up a little bit later. But the general thought is, we say this all the time as far as news events and binary noise and binary events and being noise and general trends that are still going to do trendy things. And so what's in my head right now as I continue to figure out how to interact with this market is along those lines of, the general trend is still there, which is what we've talked about before, where we've peaked and we converted to a downtrend, and we've been on a downtrend. But tying in the elasticity of the market, and the elasticity is the unknown. It's the great unknown, that we can always say what a most likely, a most probable next level is and all that kind of stuff. But when you get so many news events and so many massive binary events that, trend is down, we know that that's not changing. None of these news events are changing that, but they're changing the elasticity of the market, and they're inducing some of that panic selling or FOMO buying, and it's just causing these huge swings in the market. And that is where I particularly am getting a bit exhausted is seeing price action not be invalidated to anything we've ever said. Again, binary events and catalysts, and fuel on the fire and whatnot. But the fact that these moves, because of these catalyst events, these moves, these price action moves are playing out so fast. I mean, we've seen after hours charts of an index and it just happened in the Discord. I think it was last night, where there was a big drop, and then after hours trading, it showed a perfect price action move where we had dipped, and then we came up and tested the bottom of this range, and then we were dumping again by the time the market opened. And so all of these moves are unfolding so fast because of, again, those catalyst events, that it's really hard to be playing a strategy where these same exact moves could have been in another alternate timeline, could be the moves that the market was always going to make, but it was going to do it over days or weeks. And we're seeing the price action unfold so ridiculously fast. And so that's kind of the basis of what's been my experience so far, is just feeling like I see a trade setup, and then I better not take my eyes off it because I could blink and it could have already happened, and now it's doing something else. So I feel like that's kind of where I'm at with general exhaustion of this market, is just the speed that everything's happening. I think is
I think that's a really good call out and a really
summary.
good observation that you had, and likely that's also kind of a lot of my hesitation is, I don't have the time to be able to track the market throughout the day. It's just not my daily life doesn't allow for it, which is why I like my premium selling play, is because it's a little bit of a slower burn. I mean, it's not slow like a long-term investment slow, but it's slow like I can research this, I can put the trade on, and I'm not going to worry from one day to another that something's going to absolutely explode during the day against me or for me. That type of thing. And so I'm very comfortable kind of taking a look at my portfolio at the lunch hour, the end of the day, in the evening. And with this particular market, with these type of whipsaw actions, you really can get thrown deep in the money, deep out of the money, from 1 minute to the next. And that just doesn't make me comfortable. I think in the very beginning, I had a little picture up there that said me watching price charts at 3 a.m. instead of sleeping. And if you think way back to some of our risk tolerance episodes forever ago, a lot of people are like, well, how do I know what I'm risk tolerant to? I want to make money. And the thing that I usually tell people is, if you sit at home at night in your bed and you're trying to fall asleep and you can't think of anything but what's happening to my positions, your position size might be too big. Your risk might be too great, right? It's distracting you. If you can comfortably put your stuff on and completely kind of forget about them during the day and, only think about them when you pull them up, that's probably the appropriate risk size. That's probably the appropriate risk tolerance for you. And that's where I find myself, and why I'm not playing earnings is because there's just too much whipsaw action that it exceeds my personal comfort in that strategy.
Yeah, absolutely. And that definitely that anxiety that you're speaking about in position sizing, very much something that's worth paying attention to and taking note of, because it's definitely a key sign that something in your strategy is not set up properly. Because even if you're swing trading, your entries should be clear, your stop loss should be clear, your profit targets should be clear. Um, there shouldn't be a situation where you have a trade open and it's open ended and you it could just go nuts on you at any moment. There's probably something you want to rework there. Just real quick, I just wanted to show kind of some interesting visuals of what I was talking about as far as the elasticity and this whipsaw nature of what we're experiencing right now. So I have this daily chart of the S&P, of the SPY, and what I wanted to call out was these moments when we get these highly elastic moves, even a little bit here. That's 2023. I think it was even closer. Yeah, right next to it here. But most notably, obviously, back the pandemic start back here. And what I'm referring to is we have this trend in the market, and I'm using this trend line here just because it helps as a visual aid, where you can see that green is we're going up on a solid trend. 2016 all the way through 2017, just a slow and steady up we go. A little dips here and there, obviously, and then the first major elasticity move here, the start of the pandemic. You can see that where the price actually corrected to, if you just do like some very rough price action on the trend line, we had a high back here, and the trend line retraces kind of to a retest of that previous all-time high there. But that elasticity, that panic moment, that overselling kind of sends us down this big move down that we snap back up from, and then we start plodding along up. And then this is, what would generally be considered a true bear downtrend market here. That's throughout 2022 into 2023. But that kind of captures what I'm talking about as to what it feels like we're seeing right now. And I'm not at all predicting that it's going to resolve similar to what happened back in the pandemic and 2020. But it's certainly that sort of dramatic move to the downside that we also had back there. And overreaction, stressing the market to the downside, it's going to snap back up. And then just on a micro scale, if we zoom in, this is kind of what I was talking about. This is looking on the 3-minute chart on the SPY, and just what happened last night as of this recording. These shadowed boxes here are after hours. So the black bar areas are trading hours. The blue and the yellow are after hours. And all entirely in after hours, we had what is perfectly normal price action where we had this level here. We lost it. We came back up and we tested it, and then we failed and it held as resistance. And so we went down and made a lower low. Totally normal. totally within the realm of acceptable or most probable PA. But the fact that this unfolded largely after hours, I mean, this is not an insignificant move on a major index here. This was a 1.5% dip, then a 1.5% rebound, all after hours. I don't know if you know anything about last night. I feel like there was some news involved, but some of this happened at like 4 a.m. So who knows? But then we're back at it and whatnot. So this is kind of what I was referring to as far as the speed that this stuff is happening. Sometimes the inaccessibility of it. I mean, this is all after hours. Your options for taking advantage of these kind of things is very limited. But I guess some of that gets into struggles that I have being active in the crypto markets, being 24/7 tradable, and the limitations around equities. But that's neither here nor there. This kind of shows just that rapid speed price action where, this was a perfectly valid move and it just unfolded while I was sleeping. So not that I had a trade for this move, but that's just kind of feels like how fast everything's happening.
No, I mean, yeah, you do have to remember, Viper, that people need sleep too, and maybe that's why there actually are market hours, and those crypto people are a little bit weird trading 24/7. So I don't know.
Well, I mean, and I mean, in my defense, I'm not saying I want to be up at 4 a.m. I just want an order to fill at 4 a.m. If I was trying to play that move and it unfolded after hours, none of those orders are getting filled. That's kind of the liquidity flowing 24/7 or standing orders. Is
so. I mean, what's someone to do in a market like this that where you're not really that comfortable? Maybe making some of your trades, maybe it's moving too fast for you, or you want to just step on the sideline. Is there something you can do? And that's where I kind of would call out, one of the other things that I'm doing right now that I'm not stepping on the sideline for, and that really goes to my investing side of things. And that's not something we really talk about a lot on this show because the show is really Blockhead Traders. It's really our ins and outs. But I know Viper has done dollar cost averaging into things himself. That is one of the strategies that I kind of deploy in my retirement portfolio. I have ETFs and mutual funds and things like that I have picked out for my retirement fund. And I take opportunities whenever there's large market drawdowns to go in and make buys with my cash. And I'm very, very comfortable in there making buys on, a 3% drop in the market, a 2% drop in the market. So I look for these big overall drops. And then I say, that's time where I'm going to go in there and I'm going to plunk down and increase by, 0.5% or whatever the position sizing happens to be. Because I know that the phrase time in the market will always beat timing the market. And I don't have the attention or the time to kind of devote to that retirement portfolio to actively trade it as much. And so I have the composition that I'm looking for in ETFs and mutual funds, and I just take these drawdowns as an opportunity to go in and buy more. And that's an easy trade for me. And that's something that, you guys should consider out there as, maybe that methodology fits to your style. And that's something you can take advantage of in drops like this. Viper, I know that you're a little bit braver than I in some of the market moves. I don't know how that strikes you, or if you do a similar strategy, or if you'd been doing some active trading in these thrashy markets.
No, that's a great call out because, like you mentioned, I have. I mean, as much as I've talked in the past about trying to find my niche, my thing, and what works for me. It's not entirely fair for me to say that and not call out the DCA strategy that you just mentioned, because that strategy that I deploy when it comes to dollar cost averaging is absolutely kind of killing it right now. And so what I do for that, to put just a little bit more mechanical tangibility to it, is if you just picture that chart that I just had up of the SPY, it could be anything. It could be Bitcoin as a representation of the crypto market or whatever. Something that has that index capability of showing a large time frame trend. And what I'm doing now, based on experiences gained over the last 3-4 years, is we're clearly in a downtrend. And so I have a bag of capital that is specifically earmarked for this DCA, dollar cost averaging strategy. And because we're in that downtrend, I've ramped that up, and I have a select basket of assets that I just have it set every day, purchase X amount every day. And regardless of what the market's doing, we just do that every day. And so the high level strategy is, so long as the trend is clearly down, and again, picturing that high level SPY chart where you don't have to time the dip, you don't have to time the perfectly bottom, you don't have to time the perfectly top, just the general trend direction that's pretty clearly observable in real time on that chart. So as long as we're in the downtrend, I ramp up that daily buys, and then I keep grabbing those as we go down there, and that's bringing the costs, that's bringing my basis down with it. If we get some crazy volatility pump, then opportunistically, if I'm thinking about it, I might go look at the account. If I happen to be above my cost basis, then I will pretty aggressively take profits on that, because I want to keep stuffing the bag to have more money to buy as we keep trending down. And so that is doing a great job keeping my cost basis trailing the market, basically. And then the big picture is, as we curve and we start going up, not to get emotional, and when things start going into profit, do the opposite. And this is a little more hands-on than a super long-term approach, but as it starts going up, I start taking profits, peeling out. My personal goal is, every time there's, depending on the asset, every time there's a 10 or 15% increase in profit, then I sell 10% of the position. And I just blindly do that. And so that way, the whole way down, I'm adding and lowering my cost basis. The whole way up, I'm taking profits out. And so then we just kind of ride like that. And in theory, kind of a compounded interest situation, though there's not actual interest involved. So that's a big thing that I'm doing right now. In addition to playing around with options, earnings strategies, which I think I kind of talked about before with the calendar spreads. But those are kind of my two primary things. And right now, I'm feeling pretty good about the DCA strategy. It's one of the things helping keep me sane, because the trend is the trend, and regardless of how fast swing trades are unfolding, that feels as a nice little comfort to have that in the back pocket.
So, have you actually been taking earnings trades in this past week, as far as when the volatility has really kind of been ripping up and down?
I have, and if we want to take a look, we can take a look at my journal log so far on the earnings trades that I've taken, and this goes March 25th was the first one on the log here, and then I just closed out a trade that opened on April 7th, but I just closed it out today, April 16th. So that was actually longer than I expected, but there's a couple of things I want to point out here. First of all, I don't really want to get into exactly the strategy, because I feel like that's just going to run us long. But we could dig into it certainly on a future episode. But the primary vehicle that I'm using here is called a calendar spread. And just at a very high level, that is, I am selling and buying a put or call at the same strike price. And the only difference between what I'm buying and selling options wise is the time to expiration. So it's the same exact strike price, let's say $14, and I sell the short one that's coming up very soon, usually within a week is the first expiration. And then I buy the long one, which is a month after the one that I sold. So that's just at a very high level what the calendar spread is. And in particular, this is I think the best way to put it is it's kind of the particular algorithm that I'm using is to arbitrage what we talked about on a previous episode, backwardation, where there's a pricing imbalance and the front month has an elevated value to it that is out of line with what is fair pricing. And so I'm trying to capture that delta in the overpriced front month to the back month. So that is to say, I don't know exactly, and certainly would love to get your thoughts on how volatility should play into that strategy, or if it even matters. But this is the results of what I've done so far. I've taken 6. Is this 6? Yeah, 6 trades here on these tickers. You can see that I have 2 wins and 2 losses, which, hey, that sounds pretty great. This implied move column is interesting because part of my calculation is calculating what the expected move of the earnings event is going to be. I know in your strategy, you usually use, I think you use delta in this particular case to try to, or deviation of, to try to capture what you think the move after earnings will be. This is derived based on the options pricing and how the market is pricing in the move. And so far it's held up really well. I should probably put like an actual move after it just as information to see how well it holds up. But I'm sure it holds up pretty well across the board because that's a pretty standard way to measure it. So we're looking at this and we're like, that's
66%
pretty solid.
success.
4 wins, 2 losses. But yeah, 66%. So I'm rolling in it, right? But I am net negative on this current strategy. And that brings us, friends, to position sizing. If we scroll over here, we can see what the open price was. And this is, again, because of the mechanics of this particular strategy, I pay a debit to open these positions. So I'm buying the position, and then that is my max loss. Whatever I paid for it, it could go to 0, as it has in a couple cases. But that's my max exposure, is whatever I paid for it up front. And so what's really important to notice here is you're looking at these open prices, and this is the size is number of contracts that I did for this. So ultimately, I should add a column. Total price would be open price multiplied by the size here. But you can see there is kind of a standout situation here. Like the math is working out here. So this guy's $160 or $1.60, $83, $1.40, $60, $100, $1. And then there's this guy right here, $5. Quite the standout here. And it just so happens this was a total loss, I believe. What did I close that thing for? Oh, okay, I closed it for 50 cents. Cool. So $4.50 lost on that particular trade. But so the issue here is in position sizing and how it kind of just throws the stats completely out the window. A 4-2 win doesn't mean anything when one of those losses outweighs all of your total returns combined. And so that's something I need to work on. And it was in my mind as I was taking these plays. In this particular case, clearly a stop loss situation should have been deployed. So in the grand scheme of the account, part of my thinking was this $5 trade wasn't a risk on a big picture. But what it was a risk that was not on my mind was how oversized it was to these other positions that I'm taking. So I have 2 options. One, I don't take this trade next time something like this comes up, or I increase all trades to maybe normalize around this $5 mark. And then all of a sudden I do that, and the total P&L of a 4-2 win ratio.
Yeah, this is actually
starts to work a lot more
one
in my
of the
favor.
big observations that I had, or early lessons I had in premium selling. because premium selling is all built around the concept of statistically, if you have enough events, they statistically will gravitate around the probability of the delta moves and all that stuff. And I 100% found out that is 100% true. And so you want to target as many occurrences as possible. So you want to put on as many trades as possible. And one of the things that I did, much like you, was I just tried to dump as many trades out there on as many names. And some of the names were bigger than other names, but I didn't ever change. I basically looked at it from I'm going to do 2 contracts or something to that effect, right? I did it by quantity, not by dollar value. And so my dot sizes, or basically the amount of capital deployed at each of these data points, was not equal. And so that worked out great if you happen to oversize one of those data points and you won. But like you experienced, if you don't keep them all the same, then your statistical distribution, while your win rate is there, it doesn't translate to your P&L being in your favor. And so you can completely wipe out a lot of those gains if you don't keep them all the same and one of your losses is relatively outsized. So yes, keep it the same if you're going for the law of probability in the P&L.
Yep. Yeah, which I really would encourage anyone that wants to get into options, very specifically options. I would say this is really, really important. I mean, certainly not an options professional, just exploring it myself. You've obviously been there a lot longer, but still neither of us are financial professionals, as you hear every time. But I would say if you're going into the options world, so much of it is based on that statistical probability, and so much of being profitable in that is leaning into the statistical probability. Don't go monkey wrenching it up by throwing it all out the window by doing something like this, because this negates all of that statistics. This is such a wild wrench in the machine that it throws all the math out the window, and it makes it not reliable at all. So going forward, we'll check in again maybe after the next major rounds of earnings seasons and see how I adjusted and which way I decided to balance out. I really like the dollar position, the $100 plays, and then if something comes up and it's $5, well, tough luck. That's just too big for the budget. So we'll just not do that until it becomes more acceptable or whatever. So we'll see how that plays out over time. But regardless, whichever way it goes, the primary factor is put it all on the same level playing field, because this is one of the easiest variables to control in your strategy, is making sure the repeatability is there every single time, same position size.
And that brings us to the end of this week's episode. Like I said, the markets are super turbulent right now, and sometimes you really got to lean on your risk tolerance and your comfort. And it is a perfectly acceptable strategy to sit on the sidelines and not participate in a lot of the volatility. If you're comfortable, then go for it. If you're not comfortable, it is perfectly okay to sit out. It's kind of like when you're a child or smaller and you're kind of going to the ocean and the waves are super big and you're only comfortable going into your ankles, right? And that's fine. And when you get a little bit more comfortable with the ocean, you get a little bit better at swimming, stuff like that, then you go out and you surf the waves a little bit more, or you jump in them, maybe up to your waist, maybe up to your chest. And that's really the same with the market, is understand what your tolerance is and then just stick to that tolerance. Now, you might say, well, what if I'm going to miss out on something, right? And that's where I think you have to look at the different strategies that are out there and not be a one-trick pony, right? So that's where I told you, I have a strategy where I have my retirement account and I want a dollar cost average in, and this volatility is fine to have that. I wait for my 2% market pull down days and I go and I allocate some funds to that, because time in the market will always beat timing the market. And so I think it's a combination. So I don't know that you ever really have to stay totally on the sideline, but you might change based on the volatility, based on the market conditions, what you're comfortable trading. And that is really what gives you, as an individual, a more versatile toolbox to participate in more of that market action. And so just kind of understanding the different capabilities that are out there, just focus on that. Try to learn it. Try to figure out where that fits in your risk tolerance. Right now I stepped aside from premium selling this past week. Now I'm considering getting back into it as this is earnings season, and I do think some of the volatility has really come down. The VIX has given up a lot of its gains, and yes, it's popped up a little bit, but nowhere near the level that it had popped up a week or so ago. And so I think that the dust is starting to settle, and I'm starting to get a little bit more comfortable to re-enter that. And that's what you're going to have to judge for yourself. So hopefully this has been somewhat insightful to you, and you've learned a small nugget of information, and you can go out there and find your trading style, find your comfort level, and participate in these markets. So good luck, have fun, and remember, think outside the block.